economic and financial information received since our October meeting has been consistent with our expectations of continued improvement in the labor market. And as I've noted, continuing improvement in the labor market helps strengthen confidence that inflation will move back to our 2% objective over the medium term. That said, between today and the next FOMC meeting, we will receive additional data that bear on the economic outlook. These data include a range of indicators regarding the labor market, inflation, and economic activity. When my colleagues and I meet, we will assess all of the available data and their implications for the economic outlook in making our policy decision. The committee anticipates that even after employment and inflation are near mandate consistent levels, economic conditions may, for some time, warrant keeping the target federal funds rate below levels the committee views as normal in the longer run. This expectation is consistent with an implicit assessment that the neutral nominal federal funds rate, defined as the value of the federal funds rate that would be neither expansionary nor contractionary if the economy were operating near its potential, that rate is currently low by historical standards and is likely to rise only gradually over time.
Yeah, I think this divergence has been a big theme of ours all year, and you've seen it playing out in the FX markets. So we continue to think that the dollar can strengthen further. We've seen a big move already, but we think it has further to go, particularly against the euro and also against those Asian currencies or currencies of those Asian countries that are in deflation and where central banks will be in motion. So I think that's the best way to play the monetary divergence. Also, if you believe that the ECB will surprise on the upside again tomorrow, as I do, then I think that also still bodes well for the European periphery, particularly Italian bonds. And we also think that bank bonds in Europe can do well in this environment where the ECB is still easing, while the Fed is embarking on what we think will be the most dovish rate hike we've ever seen.
Well, oil should stay under pressure for a while. We think it'll be under even more pressure because of OPEC production in Q1 when Iran is expected to come back in the market. Nobody knows by how much. The government is claiming starting off with 300,000 to 500,000 barrels a day, ramping it up to 1 million barrels a day within a year. I think the market is doubting it, but it's very unsure of what's going to happen until it happens. The market is clearly expecting that the price is not going to go up significantly, not through 2016 and maybe not through 2017. I think that that's a little bit too narrow-minded. It's based a bit on 2015 experience when a lot of people thought non-OPEC oil would turn over. We'd see lower non-OPEC production. We now think that that's almost a certain bet for 2016 rather than 2015. And when that starts happening, I think the bulls in the market will start appearing again.
Ed, appreciate